Welcome to the deep dive. Today, we're tackling, getting you prepped for trading. You sent us your study guide for Come Into My Trading Room.
Oh, that's a great book.
It is. And we're going to help you kind of sift through it, find those golden nuggets.
Yeah.
It's a very popular trading book.
Yeah.
So you've got this study guide. It's like having a treasure map to navigate, this world.
Yeah, it's a smart move using a study guide for sure. Shows you're serious about learning.
Absolutely.
Not just looking for that get rich quick kind of thing.
Yeah, exactly. And this study guide, it's like, I think it is the key to unlocking the book's secrets. It's got everything you need from trading psychology to technical analysis.
Right.
And we're going to make sure you understand what's really important.
Yeah. And what's interesting is the author of this book, he's got kind of a crazy background.
Oh, yeah. Tell me about it.
Yeah. So he was actually a psychiatrist in the Soviet Union, even worked as a ship's doctor. Can you believe that?
Yeah.
Before he came to the U.S. I think that really kind of shapes how he looks at trading.
Interesting. He doesn't just, focus on the technical stuff.
Right.
But he really brings in that mental game, which I think a lot of people miss.
Yeah, for sure.
It's huge.
Okay, so let's dive into the first part of the study guide, which is kind of laying the foundation of financial trading. One thing that I saw that was interesting was this whole efficient market theory, right? And it kind of suggests that in a truly efficient market, a trader's success after a year could be more due to luck than skill. What?
Yeah, I know. It sounds kind of crazy, right?
Isn't it all about skill?
Well, that's what a lot of people think. But this efficient market theory, it's saying that if the market's truly efficient, all the information that's out there, it's already reflected in the price.
Cool.
So unless you have some, insider information, which is illegal, by the way, it's really hard to consistently beat the market.
So does that mean it's impossible to make money?
No, not at all. It just means that consistent profits, they require more than just luck.
Okay.
Or following some hot stock tip. You need a real solid strategy. Got it.
You got to base it on careful analysis, risk management, and discipline.
So it comes back to you and why you're choosing to trade in the first place, right?
Exactly.
Are you in it for the excitement, the challenge?
Yeah.
Or are you looking to build long-term wealth?
Right. I mean, that question really shapes your whole trading journey.
I agree.
And that actually leads us perfectly into the mind section of the study guide.
Okay.
Which is all about the psychology of trading.
Interesting.
And I think it's probably the most important part of the book.
Really? Why?
Well, think about it. In sports, even the most talented athlete, they won't win if they don't have the right mindset.
Oh, I see what you're saying.
Right. So what are some of the key takeaways from this section? One of the biggest things for new traders is their emotions.
Okay.
Their emotions drive their decisions.
Yeah.
Fear and greed, it can lead to, impulsive trades. You start chasing losses, taking on too much risk. And, the study guide emphasizes how important it is to be disciplined.
Yeah, but isn't trading all about, intuition? Like using your gut?
Well, I mean, intuition can play a role, sure.
Yeah.
But it's not enough.
Yeah.
Successful trading needs a structured approach.
Yeah.
Right? Based on analysis.
Right.
Risk management.
Okay.
And a clear understanding of your own, strengths and weaknesses.
So how do you develop that discipline? It sounds a lot easier said than done.
It is. It takes practice. Self-awareness. You got to be willing to learn from your mistakes.
Right.
And, the study guide recommends keeping a trading journal. I don't know if you've ever done that.
I haven't, but it sounds interesting.
Yeah. You track your trades, analyze your decisions, and you start to see patterns in your own behavior.
Okay. So a trading journal, what would I even write down in there?
Everything. So the date and time of your trades, your entry and exit points, how much you made or lost, but most importantly, what was your thinking behind each decision?
Okay.
Were you feeling confident? Were you scared? Were you greedy? Did you stick to your plan?
Right.
Or did you, go off the rails? And when you analyze your past trades, you can really start to see, okay, what are my strengths? What are my weaknesses?
I see.
And you can develop strategies to make better decisions.
So it's almost like having a coach.
Yeah.
Who's helping you analyze how you're performing and get better over time.
It is.
Yeah.
And the more you do that, the more you reflect on your trading, the better you'll understand your own trading style.
Yeah.
And your risk tolerance.
Yeah.
Which is crucial, for building a plan that works for you.
That makes sense.
Yeah.
Okay, so we've covered this efficient market theory and the importance of discipline and like having that mindset.
Yeah.
Now I want to get to like the technical side.
Yeah.
How do we start reading this language of the market?
Right.
These charts and graphs and things that look so intimidating.
Yeah, I mean, charts, think of it as a visual representation of the battle between buyers and sellers.
Okay.
Right. You get your bulls and your bears.
Yeah.
They're showing us the price history of something, which gives us clues about what might happen in the future.
But there's so many different charts and indicators, and where do you even start?
Well, I mean, the study guide does a good job of starting with the basics of chart reading, introducing some key concepts like support and resistance levels, trend lines, and chart patterns. These are the kind of the foundation of technical analysis.
Okay, I'm starting to see how this all kind of comes together.
Yeah.
But I gotta be honest, I still feel a little intimidated by all this jargon.
It's understandable, but don't worry, we'll break it down step by step.
Okay.
The key is to start with those fundamentals and just build your knowledge gradually, right? It's like learning a new language. First, it's overwhelming.
Yeah.
But with practice, you start to see the patterns, understand what it all means.
Okay, I can get behind that. So one thing that really stuck out to me in the study guide was this idea that the closing price of a stock is often a better reflection of professional opinions than the opening price. Why is that?
That's a great observation. You know, professional traders, they tend to be more active towards the end of the day.
Okay.
They're adjusting their positions based on, how the day went.
Right.
Amateurs, they're more likely to place their orders, before work or maybe react to headlines throughout the day.
I see.
So by looking at the closing price, you're kind of getting a glimpse into what the smart money is doing.
Okay. It's like peeking behind the curtain,
Correct.
seeing what the pros are really up to.
Exactly. And that kind of insight can be super valuable when you're making your own decisions.
Yeah, for sure. Now, I'm curious about these indicators that the study guide mentions. Are they like secret weapons, to like predict the future?
Well, I wouldn't say they're secret weapons,
Okay.
but they are incredibly useful tools. Think of them as like power tools for traders. They help you see beyond the basic chart patterns.
Okay.
And identify potential opportunities.
Okay, I'm intrigued. Can you give me some examples of these power tools?
Sure. You've got two main categories. Trend-following indicators, which help you spot momentum.
Okay.
Right. So you're riding the waves of a trend.
Got it.
And oscillators, which help you identify overbought or oversold conditions.
So it's like having this toolbox full of different instruments
Yes.
to analyze the market.
Exactly. But just like any tool, you got to know how to use them.
Right, of course.
The study guide does a good job of giving you an overview of the most popular indicators, explaining how they work and how to interpret the signals.
Got it.
So you're not just blindly following them.
Yeah, that's really helpful. So, okay, we've got this disciplined mindset, our basic chart reading skills.
Right.
Now we've got these powerful indicators. What's next?
Okay, so the next step is figuring out how to combine all of this into your trading strategy.
Yeah.
And that's where it gets really fun.
I can't wait to delve into that. But I think maybe first a quick break just to let all this sink in.
Yeah, sounds good. We'll be back soon to keep going on our deep dive into trading.
Perfect. Okay, so we've laid the foundation right. Efficient market theory, the importance of discipline, and we're starting to get a handle on chart reading.
Yeah, we're making progress.
I'm ready to get to the practical stuff.
All right, let's do it.
How do we actually use all this to, make decisions?
So the next section of the study guide is all about putting it all together.
Okay.
It talks about this thing called the triple screen trading system.
Triple screen trading system.
Yeah.
What's that?
Basically, it's a framework for analyzing the market using different time frames.
Different time frames. I'm not sure I follow.
Okay, imagine you're looking at a map.
Okay.
Sometimes you need to zoom out to get the big picture, right?
Right.
And sometimes you zoom in to see the details.
Yeah, that makes sense.
Trading's kind of the same. We use different time frames to get a more complete understanding of what's going on.
So it's like looking at the market from different perspectives.
Exactly.
Okay, so how does that actually work?
So the triple screen system uses 3 different time frames.
Okay.
You got your long-term trend, your intermediate trend, and your short-term trend.
I see.
The long-term trend kind of gives you the overall direction of where the market's going,
Okay.
while the intermediate and short-term trends help you pinpoint your entry and exit points.
Got it. How do you choose which time frames to use, though?
Good question. It depends on, your trading style
Okay.
and how much time you have to actually analyze things.
Right.
So, for example, a swing trader, they might use weekly charts for the long-term trend, daily for the intermediate, and maybe hourly for the short term.
Okay.
But a day trader, they might use daily charts for the long-term trend, hourly for the intermediate, and then like 15-minute charts for the short term.
So finding the right combination for your goals.
Exactly.
Okay, so the triple screen system helps you analyze those different time
It
frames
gives you that framework, yeah.
to find those trading opportunities.
Right.
Okay, this is getting really interesting. I know the study guide has some actual chart examples. Can we go through a couple of those, see how this all comes together?
Let's do it. Why don't we start with one that really focuses on money management?
Okay.
Because as we talked about earlier, that's crucial for success.
Yeah, absolutely. I'm all ears.
So there's this great example using Oracle, ticker symbol ORCL, back in the early 2000s.
Okay.
It shows how even when you think you found a good trade,
Yeah.
protecting your capital is the most important thing.
Right.
Remember those money management rules we talked about? The 2% and 6% rules?
Yeah, those are pretty eye-opening. I'm still not sure I totally get why those specific percentages are so important, though.
Okay, so the 2% rule, basically, it says you shouldn't risk more than 2% of your total trading capital on any single trade.
Right.
It's like a safety net.
Right.
Keeps you from making one big mistake that wipes out your whole account.
Okay, that makes sense. What about the 6% rule, then? Why stop trading for the month if you hit a 6% loss?
That's your circuit breaker.
Okay.
It's there to protect you from yourself, honestly. When you're losing, it's easy to get emotional.
Right.
Start chasing those losses, which usually just leads to bigger losses.
Yeah.
The 6% rule, it makes you take a step back.
Okay.
Reassess, come back when you're thinking clearly.
That's actually pretty smart. It's like a built-in cooling off period.
Exactly. So back to the Oracle example.
Yeah.
So the study guide shows these charts from back then when the stock seemed to be bottoming out, after a pretty big decline.
Okay. So we're looking at a potential buy.
Right. But remember, even in a situation like that, you got to manage your risk.
Right. Of course.
So the study guide suggests entering a long position on ORCL,
Okay.
but with a stop-loss order placed below the month's low.
Can you remind me what a stop-loss order is again?
Yeah, so it's an order you place with your broker
Okay.
to automatically sell your shares if the price drops below a certain point.
Right. Okay.
It's your safety net, right?
Yeah.
Limits your potential losses.
So in this case, if Oracle's price falls below the month's low, the stop loss kicks in and we're out.
Exactly. Protects you from that big loss.
Okay, I like that. So how do we know when to exit a trade?
Well, sometimes the market gives us signals that it's time to take profits,
Okay.
even if we haven't hit our target.
Really?
Yeah, and sometimes those signals tell us to get out even if we're still making money.
So we're not just waiting for a certain price.
No, it's about reading those clues
Yeah.
and reacting.
Okay, like what kind of clues in the Oracle example?
So the study guide shows the stock rallied after the entry point, but it never quite reached the upper channel line.
What's the upper channel line?
It's a technical indicator that suggests a potential area of resistance.
Okay.
So even though the stock was going up, it couldn't break through that resistance.
So that's a warning sign.
Yeah, like the upward momentum might be fading.
Yeah.
And there were other clues too, like the force index.
The force index.
Yeah, another indicator. It was showing a triple bearish divergence.
Okay, hold on. Bearish divergence. I'm getting lost in the terminology.
No
there.
problem. So a bearish divergence happens when the price is making higher highs.
Okay.
But the indicator, like the force index, is making lower highs.
I see.
It means the momentum behind that rally is weakening.
So it's like the engine sputtering even though the car's still moving?
Perfect analogy. And in this case, the bearish divergence along with a declining MACD histogram suggests it might be time to take those profits before things reverse.
So recognizing those warning signs and acting fast.
Exactly. The triple screen system helps with that.
Okay.
And of course, good money management.
This is starting to make a lot of sense. Can we look at another example just to see how it applies in a different situation?
Yeah, for sure. Let's look at Sun Microsystems.
Okay.
Ticker symbol SUNW. Another tech stock that had quite a ride in the early 2000s.
Okay, what happened there?
So SUNW was a high flyer in the late 90s. But like a lot of tech companies, it crashed in the early 2000s.
Right.
The study guide shows charts from around October 2001,
Okay.
when the stock seemed to be finding a bottom after a period of consolidation.
So another potential buy. But didn't we say that even then we still got to be mindful of risk?
Always, always. The study guide stresses that. Using a stop-loss order to protect your capital.
Okay.
In this case, the stop loss would be placed below the previous day's low.
Right, so if it drops below that, the stop loss kicks in, we're out.
Exactly. Okay, let's see how the trade plays out. The chart shows SUNW rallied strong after entry,
Okay.
but then the momentum starts to fade.
How can you tell that?
Well, one clue is a chart pattern called a blow-off top.
A blow-off top.
Yeah.
What's that?
It happens when the price spikes above the upper channel line.
Right.
On a huge volume bar,
Yeah.
and then it quickly closes back within the channel. It often means the buyers are exhausted.
Oh, I see.
And a pullback's coming.
Like a final burst of energy before the party's over.
Exactly. And here, the blow-off top, along with a declining MACD histogram and a bearish divergence in the force index, all suggest it's time to take profits.
Again, recognizing those warning signs. Acting before things turn around.
Right. And the triple screen system gives you that framework
Okay.
to analyze the different time frames and make better decisions.
This is amazing. I'm starting to see how everything fits together.
Yeah, it's all connected.
Can we look at one more example? I'm really eager to see how this applies in different scenarios.
Absolutely. Let's take a look at Crowlink.
Crowlink.
Yeah, ticker symbol KROL. It's a corporate security firm. And they had a wild ride after 9/11.
Oh, wow. Yeah, that was a crazy time in the market. How did their stock react?
Well, demand for security services went way up after the attacks.
Of course.
And KROL's stock price reflected that. But even in that situation, the technical signals were still clear.
So even when things are unpredictable, the charts can still guide us.
Exactly. That's what's so powerful about technical analysis. It can help you find those turning points.
Okay, so what did Carol's charts tell us?
So the weekly chart showed a pattern called a saucer bottom.
Saucer bottom.
Yeah, it's a bullish reversal pattern.
Yeah.
Suggests a potential uptrend. And to confirm that, the MACD histogram and MACD lines both showed bullish divergences.
Wait, you keep saying bullish divergences. Can you remind me what that means?
Sure. So a bullish divergence happens when the price is making lower lows.
Okay.
But the indicator, like the MACD histogram, is making higher lows. It suggests the selling pressure is weakening, and a reversal could be coming.
So it's like the market's losing steam on the downside, even though the price is still dropping.
Exactly. And in KROL's case, this bullish divergence, along with other bullish signals, suggested it might be a good time to buy.
So even in the chaos after 9/11, the charts were pointing to a buying opportunity.
Right. And that just shows that technical analysis can work in any market environment as long as the asset is traded freely.
That's really interesting. Okay, so what happened next?
So the updated daily chart shows KROL rallied strong after entry, but there were a few chances to take profits along the way.
So even in a strong uptrend, you're looking for those exit points.
Always. The study guide shows how KROL briefly went above its upper channel line,
Okay.
which is often a sign of overbought conditions, a good time to lock in some gains.
So even though it was still going up, that inability to break through was a warning.
Right, like the momentum might be slowing down, a pullback could be coming.
Fascinating. I'm really seeing how these technical signals can guide us.
Yeah, they're like road signs.
Okay, can we look at one more? I'm really wanting to see how this all works in different situations.
Okay, sure. Let's look at Implone Systems.
Implant system.
Yeah, ticker symbol IMCL. It's a biopharmaceutical company. And they were actually showing relative strength even after 9/11.
Relative strength. What does that mean?
It means the stock was doing better than the overall market. While a lot of stocks were going down, IMCL was holding up pretty well, which often means there's some underlying strength there.
So even in a bear market, there are still opportunities.
Absolutely. And IMCL is a perfect example. Their weekly chart showed a clear bullish trend,
Okay.
with the MACD histogram confirming that upward momentum.
So while the overall market was down, IMCL's charts were looking good.
Right. And then if we zoom in to the daily chart,
Okay.
we see even more bullish signals, like a rising force index, positive MACD histogram.
So both the long-term and short-term signals were pointing to a buy.
Exactly. And the study guide shows how the stock continued to rally after entry.
Okay.
But like any trend, there were some pullbacks.
Right.
Got to be ready for those.
Yeah, of course. So what happened with those pullbacks?
So the study guide points out how those rallies in IMCL were getting weaker.
Okay.
And they weren't reaching the upper channel line.
Right.
Plus, the force index was making lower and lower peaks.
Sounds like the trend might be changing.
Yeah, and when the force index finally dropped below its center line, that was a clear signal the rally was over.
Okay.
A skilled trader would have gotten out then, before IMCL really started to decline.
So it's not just about knowing when to buy, it's also knowing when to sell.
Exactly. That's why understanding technical analysis and money management is so important.
This is really eye-opening. I'm starting to see how these concepts all work together.
Yeah, it's like a puzzle.
Okay, can we squeeze in one more example? I'm just fascinated by how this applies in so many different ways.
Sure. Let's look at wheat futures.
Wheat futures.
Yeah.
Interesting. So this stuff applies to anything that's traded, not just stocks.
Absolutely. The principles are universal.
Okay, so what's the story with wheat futures?
So the study guide uses charts from October 2001
Okay.
when wheat futures were trading near multi-year lows.
So a potential buy, but I thought the idea was to buy low and sell high?
That's the general idea, yeah, but it's not always that simple.
Okay.
Sometimes things can get oversold.
Oversold.
Yeah, they've dropped too far too fast.
I see.
And that creates a buying opportunity, even at those low prices.
So it's not just the price level, it's also the movement.
Right, and the momentum behind it.
Okay, got it. So what did the wheat charts tell us?
The weekly chart showed a series of lower lows and lower highs.
Okay, so a downtrend.
Yeah, but there were a few hints that it might reverse.
Like what?
Well, both the MACD histogram and MACD lines were showing bullish divergences.
Okay, so even though the price was going down,
Right.
the momentum was shifting.
Exactly. And on the daily chart, we saw a similar divergence in the force index. Plus, there was a failed downside breakout.
A failed downside breakout. What's that?
It's when the price drops below a key support level,
Okay.
but then it quickly reverses and closes back above it.
Oh, so it's like the sellers tried to push it lower but couldn't?
Yeah, it shows the sellers are getting exhausted.
Okay.
And the buyers might be taking control.
Interesting. So based on that, the study guide suggests buying wheat futures.
Exactly.
Yeah.
But still, remember those money management rules?
Right, of course.
2% rule, stop loss order, all that.
Got it. So what happened with the trade?
So the chart shows wheat rallied after entry, but it was a slow climb,
Okay.
and there were chances to take profits along the way. The first one came when wheat hit its upper channel line.
Right, that overbought signal.
Exactly. If you'd taken profits there, you could have bought back in later at a lower price when it pulled back.
So it's like riding the waves.
Yeah, taking profits when it's high, buying back when it dips.
Okay, that makes sense. So technical analysis gives us the framework for those decisions.
It does, regardless of what's happening in the market.
I'm really starting to understand this. Can we look at one more example? I want to see how this applies in as many situations as possible.
Okay, yeah, let's do it. Let's take a look at Vimpel Communications.
Vimpel Communications.
Yeah, ticker symbol VIP. They're a Russian mobile phone company, actually listed on the New York Stock Exchange.
Oh, wow. A Russian company. I bet there are some unique challenges with trading that...
Definitely. Emerging markets can be tricky.
Okay.
The fundamentals are harder to figure out,
Right.
and there's more political risks.
So technical analysis is even more important then.
It is, because it can help you find those signals even when you don't fully understand everything else going on.
Okay, so what did the charts for VIP tell us?
So the study guide uses charts from November 2001,
Okay.
when VIP stock was near multi-year lows after a big drop from its IPO price.
So another potential buy. But you said emerging markets are risky.
They are, but higher risk often means higher reward.
Okay.
And here, the charts were pointing to a possible reversal.
Even at those low prices.
Right. What kind of signals were we seeing? Well, there was a long-term bullish divergence in the MACD histogram.
Okay, so even though the price was making new lows,
Yeah.
the momentum was hinting at a turnaround.
Exactly. And the daily chart confirmed that
Okay.
the force index was making higher lows, MACD histogram was rising.
So buying pressure was building.
Right. Both long-term and short-term signals suggested VIP might bounce back.
And did it?
The study guide shows it rallied sharply after entry, but with some pullbacks along the way, as usual.
Right. Got to be ready for those.
Always. So the study guide points out how VIP went above its upper channel line for a bit.
That overbought signal again.
Exactly.
Yeah.
A good time to take some profits. And if you add, you could have bought back in later at a lower price when it pulled back to its 13-day EMA.
So we're riding those waves again.
Yeah. Selling high, buying low.
Technical analysis gives us the framework.
It's all about having that framework no matter what the market's doing.
This is amazing. I'm really starting to see the power of all this. Okay, can we fit in one more example before we move on? I'm just hooked on seeing how this applies in different situations.
Sure. Let's look at international business machines.
IBM.
Yeah, the classic blue chip stock.
So even those big established companies can offer trading opportunities.
Oh yeah, absolutely. Every stock, no matter how big or well known, is affected by supply and demand,
Right.
and that creates those opportunities.
So even though IBM was trading in a pretty stable range, we could still find buy and sell signals.
Exactly, and that's what the study guide shows.
Okay.
It uses charts from October 2001,
Okay.
when IBM was trading near the bottom of its range, around $90 a share.
Okay, so a potential buy, but it was trading sideways, wasn't it? How do you find signals in a market like that?
Good question. That's where technical analysis really comes in handy.
Okay.
Even in a sideways market, there are still patterns and signals to guide us.
Okay, so what did IBM's charts tell us?
The weekly chart didn't show a clear bullish divergence in the MACD histogram. It was just a bullish uptrend, meaning the indicator was rising with the price.
So even though the price wasn't dropping to new lows, the MACD histogram was still positive.
Right, and the daily chart backed that up.
Okay.
Bullish divergence in the force index, rising MACD histogram and MACD lines.
So buying pressure was building.
Yeah, suggesting IBM might break out of that sideways range and move higher.
And did.
The study guide shows it rallied after entry, but of course there are pullbacks along the way.
Gotta be ready for those.
Always. So IBM went above its upper channel line briefly.
Okay, overbought.
Right, a good chance to take some profits. And then you could have bought back in lower when it pulled back to its 13-day EMA.
Riding those waves again.
Exactly.
Yeah.
Sell high, buy low.
Technical analysis gives us the framework.
It's all about the framework.
I'm really getting it now. Okay, one more example, just to solidify this all in my mind.
Okay, sure. How about BioVale Corporation?
BioVale Corporation.
Yeah, ticker symbol BVF. A pharmaceutical company. They had been in a strong uptrend for a while.
So the stock was already doing well? Does that make it easier or harder to trade?
That's a good question. It really depends on your style and your risk tolerance.
Okay.
Some people like to buy stocks that are already trending up.
Right.
Others prefer to look for reversals.
So it depends on your approach.
Exactly. So the study guide shows charts from September 2001,
Okay.
when BVF was trading near all-time highs after a bunch of strong rallies.
So buying high and hoping to sell even higher, isn't that risky?
It can be, but remember, risk and reward often go together.
Okay.
And in this case, the charts were suggesting BVF's uptrend might continue.
Okay, what were the charts showing?
So the weekly chart for BVF showed a clear bullish trend.
Okay.
Both the 13-week and 26-week EMAs were sloping up,
Right.
and the MACD histogram was positive.
So all signs pointing to continued strength.
Yeah, but even in a strong uptrend, you got to watch out for pullbacks.
Right.
And here, there were signs one might be coming.
Like what?
Well, the daily chart showed BVF had gone above its upper channel line.
Okay, overbought.
Right. And the force index had spiked really high,
Mm-hmm.
suggesting the buying pressure might not last.
So even though the trend was up, those were warning signs.
Yeah, the study guide suggests being careful about buying at that point. But if you were already in, maybe take some profits or tighten your stop loss.
So managing the risk even in a bullish trend.
Always, always. And the chart shows BVF did pull back after hitting those overbought levels.
Okay.
The first potential exit point was when it dropped below its 13-day EMA.
So even though it was still above the long-term average, that break below the short-term one was a signal.
Yeah, like the trend might be weakening.
Okay, so if you got out there,
Right. You could have bought back in lower when it bounced off its 26-day EMA.
riding the waves again.
Exactly.
Selling high, buying low.
Technical analysis helps you do that.
I'm really starting to see the value of all this. Can we squeeze in just one more example before we wrap up?
Sure. Let's take a look at it.
Man, we've covered so much in this deep dive. It's amazing to see how all these tools can apply to like any market you can think of.
It is, right. And the study guide really goes deep, giving you a whole toolbox of indicators and strategies.
Yeah. You know, going through all these examples, I'm starting to feel like I can actually understand what the market's trying to tell me.
That's great.
But I also realize that trading it's so much more than just, looking for patterns on a chart.
It is. You're right. Remember how we talked about the author's background as a psychiatrist?
Yeah.
He really stresses that psychological aspect of trading.
Yeah, that makes sense because it's our emotions that, mess us up. We
Yeah.
make those impulsive decisions, especially when it's, our money on the line.
Exactly.
Yeah.
I mean, think about it. You could have the best trading system in the world,
Yeah.
but if you can't control your fear, your greed, you're going to sabotage yourself.
So how do we master that mental game then? Any tips from the study guide?
Yeah, there's a whole section on that, packed with good stuff. One of the biggest things is having a trading plan
Okay.
and sticking to it no matter what.
It sounds simple, but I'm sure it's harder than it sounds.
It is. It takes
Yeah.
discipline. But having a plan keeps you from making emotional decisions in the heat of the moment.
Right, like it's like a roadmap.
Exactly.
Keeps you on track when things get tough.
Exactly. So what should be in this plan? Well, it should lay out your goals, your risk tolerance, what kind of trading style you like,
Okay.
and your entry and exit strategies. And it should have rules for managing your money, like those 2% and 6% rules.
Right, right. I'm seeing how having that plan can help you like stay grounded.
Yeah, it keeps you from going off the rails.
Avoid those impulsive trades that can, just blow up your account.
Yeah, it's about being systematic.
Okay.
Not just going with your gut or chasing some, hot tip you heard.
This study guide also talked about keeping a trading journal.
Right.
Why is that so important? Is it just about, keeping track of your wins and losses?
It's way more than that. It's like a diary almost.
Okay.
Where you write down your thoughts, your feelings about each trade.
Interesting.
Helps you spot patterns in your behavior. Learn from your mistakes and refine your strategy over time.
What kind of things should I actually be writing down in there?
So for every trade, write down the date and time, what you traded, your entry and exit points, your profit or loss, but most importantly, the why.
Okay.
Why did you do it? What were you thinking? What were you feeling? Did you follow your plan or did you, go rogue?
So it's like really getting in your own head.
Yeah, it's about self-awareness.
Okay.
The more you do that, the better you'll be at controlling your emotions and making, smart decisions.
This is really interesting. I'm starting to see how trading it's just as much about, mastering your mind as it is about, understanding the market.
That's exactly it. Technical analysis is crucial.
Yeah.
But it's only one part of the equation. The real key is that discipline, managing your risk, and never stopping learning.
This study guide has given me so much to think about.
It's a great resource. Keep coming back to it as you, go on your trading journey. Remember, trading's a marathon, not a sprint.
Yeah, right.
There'll be good times and bad times. Stay focused on your goals, manage that risk, and keep learning.
This deep dive has been really insightful. Thank you so much for taking the time to explain all this.
It's been my pleasure. I hope you feel ready to tackle trading with, a bit more confidence now.
I do.
You've got the tools, you've got the knowledge. Now it's time to put it all into practice.
That's it for today's deep dive. We hope you enjoyed this exploration of financial trading. And remember, keep learning and growing on your trading journey. We'll see you next time.